Yesterday, Strategy announced that it had sold Bitcoin for the first time. And for most people, this might seem like a nothing burger, like, okay, it was a couple $1 million in Bitcoin. But for the global economy, it could have worldwide implications, possibly leading to a recession or depression because of how financial markets work. And to explain that and more, stay tuned for a lot of information that might be a little concerning if you're invested in crypto, or even the markets in general. So about a year and a half ago, I did a video that got almost no views about Strategy giving out preferred shares at 9% interest. Not giving out, selling preferred shares at 9% interest. This concerned me, it raised red flags, and if you've been watching the stock price, it's dropped over $200 a share since then. The reason I was so concerned is it basically sets up the company from being a Bitcoin holding company to basically a guaranteed downward spiral. The reason is 9% is a very hard return to make, even for most businesses. The global economy only increases by 3 to 5% a year max. So he's guaranteeing a 9% return on an asset that has no reason to appreciate. So that was very concerning. I usually have called it pretty much a Ponzi scheme. You could argue about the semantics of what exactly is a Ponzi scheme, but basically the elements are there. You're expecting higher than normal results. The mechanism of getting those returns is mysterious, poorly understood, or just does not make economic sense, which Bitcoin does not make economic sense. It cannot produce value. At best, it can hold up against inflation, but guess what? So does everything you purchase that doesn't depreciate, like stocks, bonds, real estate. Those all can beat inflation, so there's no reason that cryptocurrency would be any better than that. It would probably be only worse. Then it also has where now investors are getting paid out possibly from future investors, because when they issued this, the whole thing with MicroStrategy or Strategy now is we're never going to sell Bitcoin. We're never going to sell Bitcoin. We're going to give this 9% off of what? How are you going to give 9% of people's investments to them if you're not selling Bitcoin? They don't have enough operational income to actually pay that 9%. So that money has to come out of somewhere. And so what they have been doing is selling other financial instruments to then pay off those percentages. And they've exploded with this tactic. They've kept doing it, doubling down, doing different financial derivatives. But basically, no matter what, they are taking on either some sort of debt or obligation to pay somebody in response to getting money and then paying out to other people. That is basically how Ponzi schemes are. You take money from one person and you pay out previous people from new money that's coming in. Where this all fails is when you stop getting in new money. When you reach the limit of how much money you can get from people, there's nowhere else to go but down, and usually it goes down very quickly because you start running out of money that exists. You can't get new money flowing in, so you can only give out old money, and when you're giving out old money, that causes things to collapse because people are expecting a return on top of that money. So you end up becoming insolvent incredibly quickly. If we want to do some, quick math, back of a napkin or whatnot, to figure out how bad this is in terms of, are they doomed in a debt spiral now? I think it's not 100% certain, but it's going to be incredibly hard to recover from this. A quick ChatGPT gave me an amount of about $900 million a year that they have to pay in terms of obligations for dividends and debt and otherwise. Their valuation is only $53 billion right now, so like 2-ish%, less than 2%. They need to make that percent on their total market capitalization every year to break even. So even if Bitcoin, keeps up with inflation or is like slightly below inflation, they're just break even. So, even with inflation, you're losing. So they have to do that plus make extra to pay off that. So it's just where the numbers become very difficult to actually reasonably do, because getting anybody even a 2% guaranteed return is hard, let alone a greater than inflation percent on top of that 2%. So basically they back themselves into a corner where now it's going to be very hard to meet these obligations because they are out of cash and they don't have any other good resources to draw cash, because really, otherwise, why would they sell the Bitcoin? They would just get new debt or issue new shares. But this is basically how that Ponzi gets set into motion. Now, that might seem bad enough on the whole, but the selling of Bitcoin is a very specific negative trigger, because that lets people know that the death spiral has started. The way that it works is this is basically Terra Luna 2.0. You have MicroStrategy, that's been one of the biggest buyers of Bitcoin, supporting the price action, and their price is supported on Bitcoin going up and up and up and up. So when you're the biggest buyer, and now not only are you not buying, you are now adding selling pressure, you've now increased that more than not even buying. The problem is, when you're the biggest buyer, the liquidity dries up very, very quickly, especially when we're talking about billions of dollars a week potentially. So what's going to happen? The biggest buyer, or one of the biggest buyers of Bitcoin, now selling despite saying they're never going to sell. Okay, you can't trust their promises anymore. Them selling is going to scare the market, because now your biggest buyer is gone, so that removes buying pressure. We've added at least a tiny amount of selling pressure. That's going to cause the price of Bitcoin to go down, and it has. You can watch in the last 2 days. It has plummeted and is still plummeting. It's at, what, the time of me recording, $67,173. That means it's only going to get worse, because if they continue to try to fund things like their dividends through selling Bitcoin, that adds selling pressure. More selling pressure that the market can't take means Bitcoin's price goes down. Bitcoin's price goes down, MicroStrategy's shares go down, or Strategy, I'm sorry, they changed their name. Strategy shares go down, the cycle continues itself. They have to try to sell more to make the same amount of money to pay their obligations. All of a sudden, that 2% of their market cap can quickly grow to 3%, 4%, 9%, 10%. If it gets to 10 to 15% of their market cap in terms of their obligations, I don't think anyone would believe that a reasonable company would be able to promise those total returns on their total market capitalization, even with all this magic of crypto that's going around. So you're probably saying, okay, that's Bitcoin, that's MicroStrategy, that's not all of crypto, that's not all the world economy. That is right, but you're missing a big picture here. One, MicroStrategy and Bitcoin, they're the biggest in the crypto market by far. Everything kind of lives off of those. And with Bitcoin and all of cryptocurrencies, they all kind of have this web of them using value to support value, where they'll make a coin, say it's worth $1, then sell it to someone else whose coin is worth this, and then sell it to somebody else whose coin is worth this, when really only $1 was put in that system to begin with, but it looks like you've got $10 or $100 or $500. You're really, they say they're trying to fix the double spend problem. They're making a double spend problem, because you're making things that look like they have value, where really they don't have any intrinsic value supporting them. And that's all well and good until you actually look past that and realize, oh gosh, these things aren't the magical beans we thought they were. So the total valuation of the crypto market, according to CoinMarketCap, is $2.something trillion. I think 2.3, somewhere around there. It varies. $2.3 trillion, I probably don't have to tell you, is a lot of money. I don't have that lying around. Most places don't have that lying around. If that were to happen, the odds are that valuation for the entire crypto ecosystem is likely going to go very low, possibly to nothing, because that is theoretically possible. If that happens, that wipes out about $2 trillion from the world's gross domestic product, or the world's valuation. Once again, you might be like, oh, 2% of the world's valuation? That's not a whole lot. That is massive. When you think that the gross domestic product of the world only goes up by like 3.5-ish% on good years, 3.5 to 3.8 on decent years, and that on bad years it goes up by 2% or less, even 0%, that is enough in and of itself to cause a recession if it's already a bad year, because you just took 2%, 2% of what we think we have is gone. That's a loss. Take that off from the gross domestic product. We've just thrown ourselves from even a good year to a bad year. The other thing that's going to be the problem is the domino effect. So there's a lot of things that happen when we get into a depression or a recession, and a lot of it comes from us having an expected value of things that is not accurate to what a market value or what a real value is. Because most things are priced at their market value. that's basically what they're trading at that moment in time, what people are taking a small percentage and going back and forth with. You cannot take all that exists of that product and sell it at that price because there's just not enough money in the system to absorb that. Many times those prices can get off from what is a reasonable price. So I like using P to E ratios, profit to earnings, or price to earnings, not profit. If it's really high, that means you're getting a really small percentage of return on this. If those start getting through the roof, like 100 times P to E, this is a very bad investment. You're not going to get your money back unless you're getting explosive growth in this company. So a lot of times what this will do is this will trigger people to actually recheck if the books are right. There's a thing called paper gains or paper wealth, where on paper, it looks like you've made a lot of money. But then if you actually try to liquidate or get the money out of it that you have on paper, it's just not there because the thing is not valued correctly. So the big risk here is that it causes contagion or financial contagion. Basically, if crypto goes down, everything that's possibly associated with it, people who have gotten loans based on their crypto, people who went into debt based on their crypto, people who are using it for their retirement, all those things go down with it. That triggers a cascading effect. So things like people who loan money, real estate, anybody who's possibly, inflating numbers or relying on this can go down. That can trigger the next wave. And so this is why a lot of times countries will do things to try to put limits in place to stop it. Like if a bank goes under, they try to make sure that bank doesn't bring down all the other banks. But crypto doesn't have that. And the people who are doing things with crypto don't have those protections in place because they've not had a global recession before. So the concern is, if that goes down, can that trigger other markets to also go down? And one thing I really worry about is the tech sector. We have an AI bubble that has not returned money. We've spent a lot of money on it and we haven't gotten a return. It's very similar to the .com era, which Michael Saylor is very well experienced with, that everybody got this huge hype for the next best thing in technology, but they couldn't monetize it yet. Everyone was competing, no one was making money, and then eventually there was a bubble burst and a lot of companies went bankrupt, a lot of people lost money because the actual value wasn't there. It was all hype and people trying to find where a good investment is, where there really isn't a good investment anywhere else, and even in that, there's not a good investment. So all that money just kind of goes poof. That's what I worry about, is could this trigger an AI bubble deflation? Now, I talked to my brother, who is also a co-founder of Servetty. He does the tech side, he's coding, he does everything. I asked him about things like the processors for Bitcoin versus those for AI. They're different. So he said flooding the market with, crypto mining rigs is probably not going to cause the other chip manufacturers to lose a lot of money. It's not going to necessarily cause AI companies to lose money because they're very specifically made for that mining process. But that still doesn't mean that some sort of recession or decrease in liquidity is not going to affect them, because one person's loss is a loss for everyone. When there's less money to invest, it hurts everybody, because investment's kind of, you're basing it off of what everybody else has, what everybody else is putting money into. When you take one big section off, everybody else kind of loses that boost from having that. That's kind of hard to visualize, but it's one of those things where if your neighbor goes bankrupt and their house goes to shambles, your house is next to it, your house gets affected by that. Your valuation of your house goes down because them making lots of money and doing well makes your house look better. Them being broke and their house going to, pieces makes your house worth a whole lot less. So them being in the tech sector, a big chunk of the tech sector going under is going to make it hard for the rest of the tech sectors, including AI, to continue getting ridiculous valuations when people are eating a whole bunch of losses. Many times what people will do is they'll go, well, I'll sell such and such. So a lot of people are going into their retirements and selling their retirements. I saw an article not long ago about people diving into their retirement funds much more than usual. If they have a lot of money invested in Nvidia stock and everybody goes to try and get that, guess what? Nvidia stock goes down, it triggers the next wave of dominoes. And that's kind of what I'm worried about, is will this get into other things? There's a quote that's often attributed to Warren Buffett I could not verify that it was attributed to him, and I am far too lazy to actually Google this myself to make sure that it is accurate. But the quote is, "When liquidity dries up, the tide goes out and you see who's been swimming naked." Basically, you see who's been using, not necessarily fraudulent, but numbers that are inaccurate, because basically the bill becomes due, and if you don't have the money to pay that bill, it's very, very obvious. And so one example of ways people make these paper gains or things that look really good on paper, or paper wealth, is, for example, I have a company A that buys a building for $100,000. Then I have a company B that I also own that says, hey, I'm going to buy this for $500 million worth of shares in my company. So you do that exchange and you go, okay, great. I've got something worth $500 million. I've got something worth $5 million. We both made a lot of money when you really only put $100,000 in. On paper, the way that finances work is many times that's written down. Even though it's not an arm's length transaction, they can try to say, look, no, it's got a $500 million valuation. That's all well and good until something happens and forces either company B to sell it, or, someone to actually do an appraisal, and they realize that 500 million is not 500 million, it's 100,000. Guess what? All those things that you are relying on to say, oh, this company's doing well, the economy's doing well, those are gone. They just go poof. And so what this can trigger is everyone going and checking these things, double checking, are these numbers accurate? Do I really have a $500 million house? Do I really have this much in inventory? Are these gold bars, or are all these just nickel with a gold plating? You don't know until someone actually has this hard reset and everybody starts checking to go, okay, is this actually the market value that's accurate? Do we actually have what we say we have? Something that makes me very concerned is most of the business owners, or even my patients, I talk to them about business and what it's like being in business, and most of them have said over the last few years, it's very hard because it almost seems like the only way you can survive is through fraud, corruption, scamming, or some somewhat less than legitimate way of doing business. Corruption seems like it's been rampant, and that's bad. That means those numbers that I was talking about can easily get inflated or off from what's real, what is the actual expected market value of things. And so when one thing falls, everybody checks, we start seeing who all the bad actors are. And I would not be surprised if we got some surprises in terms of one example that I would worry about for real estate. There were a lot of companies investing in real estate very heavily during COVID. They were buying up real estate like crazy and holding it, because it doesn't cost that much money to hold real estate. You can put it on your books that you don't lose money because you don't have to sell it. You can say, I bought it for $10 million, it's still worth $10 million, or maybe based on the market, it's worth $15 million. Guess what? Now, if they ever have to liquidate that, if it's actually gone down in value, like they couldn't find someone to lease it, they couldn't make money off of it, it was just sitting on their books, and they try to liquidate it, and other people are trying to liquidate it at the same time, the domino effect continues. Those numbers weren't accurate. They overpaid for those. They just didn't realize they overpaid for it until they actually saw the real market value. And I think we're going to see the real market value of things. I hope real estate drops, especially residential real estate. But we'll kind of have to see when the dust settles, is this going to go into other sectors that have this issue, or is it just going to be crypto related? I'm worried that it will go into other things because people have been wildly speculative, and stocks have kind of done a split between most stocks and a whole bunch of not a whole bunch of, just a few tech stocks. So that makes me really worry that we've got this discrepancy between reality and the actual prices of things that is just wildly beyond what is the reality of our economy and how the businesses are running. So I think that's it. To prevent Bitcoin crypto strategy from going under, Michael Saylor is going to have to find a bigger fool than him who has a lot of money. And I think that's going to be very hard to do. So we'll see. Maybe he can get lucky and get out of this, but it's all dependent on whether he can find a bigger fool than he. If you like this video, give us a like, subscribe, comment. If you want to see more like this, let me know. We've changed it. I'm not doing this in the studio. This is just my regular messy office because it's faster and easier right now. If you want us to go back to the studio, I can do that, but it's just kind of convenient for me to do it like this. If you want to see us do any other topics to focus on business, to focus on acting, to focus on science, to focus on anything, let us know. I like this being general purpose, but we have been debating, do we do this more business centered? We are going to try to put out more Servetty videos about the software. We're going to have some big updates to the software soon, so look out for that. I think that's it. Like always, I'm Frank Ciopatini with Servetty Software, and I will see you in the next one. Servetty helps services run better. For a demo or free trial, email frank@servetty.com or leave a comment.